Hi, I'm Jim Pierce with Baton Investing. Every day, people like you come to us whenever they realize their current investment approach just isn't working. We give them an easy-to-use system that has beaten the S&P 500 by over 300% since 2003, takes just 30 seconds a month to use, and most importantly will help you achieve your financial dreams. Now today is January 8, 2015, and I want to talk to you about a stock that I believe will become one of what I refer to as the new treasury bonds of the 21st century, which is Starwood Property Trust. Not only does it rate highly, according to our unique stock rating system designed by John Reese of Validia, but it also pays an 8% dividend yield that is collateralized by mortgages on commercial real estate property. Over the past 5 years, this company has not realized a single penny of loss on any of its loans, despite being one of the largest lenders of its type in the United States. For that reason, Starwood earns a near perfect score, according to our investment strategy based on the growth investor methodology of Marty Zweig, a Wall Street legend and author of the best-selling book, Winning on Wall Street. Now, Zweig evaluated stocks with kind of a three-part system. In the first part, he really just wanted to determine whether or not a company would be able to continue to grow its earnings into the future based on its revenue growth. So when we look at Starwood Property Trust, and by the way, the trading symbol is STWD, right now trading a little under $24. This morning it was at $23.75. Zweig would look at the average rate of growth in its revenues over the past 3 and 4 years and compare that to the average rate of growth in its earnings over that same period. Now, because Starwood's a real estate investment trust, its revenues have grown substantially over that period of time, up 140%. And meanwhile, its earnings have grown at just 17%. Now, what that means is there's plenty of revenue here to pay out on these earnings, and that's the way it should be with a company like this. The interesting thing is, Starwood stock over the past year basically has been trading in a very narrow range when the rest of the stock market was growing pretty significantly. Now, I think in part that's due to the fact that this is an income play primarily, and there's concern that growing interest rates in the coming year, which is the expectation a lot of people have, would somehow hurt this company. However, the company has a lot of its mortgages linked to floating rate LIBOR, and they estimate that if LIBOR were to go up by 100 basis points, they would actually become about 10% more profitable. So actually, if the Fed does start raising interest rates in 2015, a lot of this revenue that they're booking will result in greater earnings. So this is a company a lot of people are overlooking, but with an 8% dividend yield and very nice coverage ratio on its debt, I believe, again, this is what a lot of bondholders will start looking to as an alternative to bonds, because of course, when interest rates start heading up, bonds will start declining in value. So keep your eye on Starwood. We think it's a buy up to $25 a share, and it's just one of 10 stocks in the Baton portfolio. And every month we identify the 10 highest scoring stocks out of the more than 6,000 that trade on the U.S. exchanges and rebalance our portfolio accordingly. If you want to know more about how the Baton system works, just visit batoninvesting.com and click on how it works. There's also a simple 3-question assessment to help you determine if Baton is right for you. We can only help less than half of those who take the assessment, but maybe you're one of them. So go to batoninvesting.com now, and I'll see you again soon with another free stock pick. Thank you.